With such illustrious people on the dais, you technically don't need a moderator, but let me still go through the formalities. Since we're talking about investment trends, let me kickstart the discussion with Naren. And Naren, there's one deviation that I've seen in the narration on the channel for the last 2, 3, 4, 5 months is that no longer are people saying that our markets going ahead will be dependent on the FI flows. The DII importance has never been larger than right now, and it's actually a very pleasing thing. I mean, do you think that is one single key factor, the change of people's perceptions towards investing in equity funds and thereby the importance of this?
I think clearly even today, foreigners play a bigger role than domestics. They own $320 billion of stock, whereas Indian mutual funds would own about $80 billion. So clearly, Indian mutual funds are still only 1/4. I think what the credit goes to all the people in this room is that we have managed to get money now on market falls, and we tend to lose money on big market rallies. And I think the effort done by the mutual fund industry and the distributors in encouraging systematic investment plans and balanced funds clearly has played a big role in making the moderation of the FII selling much, much better. So I think I would say that foreigners are still important because they are 4 times bigger even today. But maybe in the next 5 years, we will reach where they are. And if all the people here in this room are able to create the enthusiasm they have created from 2013 onwards. And I think this substantial focus on SIPs and balanced funds, I think, is one of the most healthy developments.
Yeah, that's true. Prashant, we just had an SIP day as well, and I think the response was phenomenal out there. The key thing, Prashant, that we've seen is it's actually, at least to our mind, you have a better sense out here, but to our mind, we're seeing this happening across the board, the investment into SIPs that Naren was talking about. Not only are people who are well entrenched in the markets doing this, but across the board, we're seeing from the peons in our office to people who actually are the money bags, everybody's investing in. That's actually a very, very heartening change. Is that one key driver towards the success of how investing will be, and will that determine how money will flow into our markets for the foreseeable future?
So I think certainly, I mean, the outlook is improving, but I mean, let's be realistic about what is the potential and where are we. I mean, if you go back to 1992, India invested almost 10,000 crores in a year in equities. More recently, in 2008, we invested 50,000 crores in equities, the equity inflows. This is a 2 trillion economy. The household savings is $500 billion a year. And what are we getting right now? I mean, we are getting maybe 5 billion a year. That's 2% of household savings. So yes, we are moving in the right direction, but I think we are a long way off from where we can say that Indians have begun to allocate a reasonable part of their savings to equities. Our gold imports are several times of the inflows in equities. So I think it's a good thing, it's a good product, and we are moving in the right direction, but I think we have a long, long way to go.
A lot of people are talking about how there are very little investment options left but the equity markets with the crackdown that this government is doing on black money as well. Now, is that a legitimate point, and is that a point that we hitherto haven't quite seen, the power of which we haven't quite seen till now?
No, so there are confluence of factors which is leading to the flows that we are seeing, and I think I completely agree with Prashant that in 1991-92 it's difficult to visualize today that an NFO in absolute terms was collecting more money than for what we collect today, and the economy has gone up like 10x. We were like probably $300-400 billion economy, now $2 trillion economy, 600 billion of savings, and the mutual funds get $10 billion. I think that amount is abysmally small. I think it's going to go up substantially. And one of the points, as you mentioned, I think as this whole move from the parallel economy to the mainstream for variety of factors, everything that the government is doing in the real estate sector, in the gold market, with the digital economy coming in, with the GST, I think that will also add, payment banks, several things, the whole Jan Dhan Yojana and everything put together. I think over a period of time, as the economy moves more and more from the parallel to the mainstream, and then with that, people have very limited avenues to invest money where you can, on a tax efficient basis, can generate double-digit returns. I think that will drive. So there is one conviction that economy will do well, markets will do well, but the compulsion that where do I put this money but the equity funds or in equity market, I think that will lead to a huge amount of flows into the industry.
Okay, now two gentlemen that we don't speak to too often on air as well. Anup Bhaskar, remember the last time that we spoke, which was at that IES student body, you were moderately bullish, not extremely bullish. Now, if indeed the flow situation is looking all right, hopefully it improves, as Prashant was saying as well. We need much more of that. What are your thoughts on the markets going ahead?
So I think the markets from the flow side are seeing the kind of optimum behavior that you can expect. It's only the reality is that we buy stocks for earnings and for dividend yield, or for the stream of dividend that they're going to give over future. And there, I think so, you can see the glass quarter full or 3 quarters, going to get filled up very soon. And we've been hoping for that filling up for some time, now for almost 2 years. So, the concerns are from that. So, if you remember in the 90s, as some of my panelists, they talked of the 90s. So in 99, 2000 was the first time I had heard about the PEG ratio, which was used for, and that was used for the case of, these companies for technology companies or actually software companies, because they were all trading at 70, 80 P. So we used to, see their growth 1 year forward and say that, PEG ratio is 1 or below 1. So if you see the period from 2003 to 2008, the PEG ratio of earnings 2 years forward for companies beyond 2 was between 17 to 30 companies out of the BSE 200. Today it is 54. So I don't want to pass any judgment on valuation, but I'm just saying if you see it from growth point of view, we are all waiting for growth, and growth is still not very visible.
Okay, I'll scratch Prashant's head on that as well. But Amit, just a quick thought from you as well. It's not just the equity markets. We speak to a bunch of experts, and they are saying, at least as far as the global flows go, the flows coming into India, to some of them, are also an offshoot of what's happening to the debt markets and the kind of interest that the Indian debt markets are generating as well. What are your thoughts on what this side of the market does over the course of the next, say, 3, 4, 5 years?
So I think the big game changer from a debt market perspective has clearly been liquidity. I guess improvement in macro is something that has helped all the markets, let alone debt markets per se. Obviously, debt markets reflect that much more forcefully through interest rates. But to me, the biggest game changer in the last 2 years has been liquidity. For the first time, core system liquidity has turned positive in India since 2009-10, and on a sustainable basis. And we no longer have this kind of a shadow boxing where you are cutting rates, but you're keeping liquidity tight, and vice versa, which we saw initially during 2010-11 and then lately during 2013-14. So these are markets where you not only have a better rate environment, but you also have reasonable good liquidity, which will ensure that products across the yield curve and across the credit curve perform. Products across the yield curve will perform well both because of rates and liquidity, and products across the credit curve will perform A because of liquidity and B because of improvement in corporate balance sheets. So in a sense, you have a market where all types of products, investment products, especially when we talk about mutual fund products per se, various positionings will work in this environment, and that is why people are so positive as far as debt investments are concerned.
We've seen Brexit and a lot of other things, and yet this market has been very, very resilient, part due to flows, part due to, well, the belief that the economy is due to pick up as well, and the ratios, if they're looking stretched for now, will improve substantially going ahead. Where are you on this argument?
See, I think if you look at it from a domestic angle, still you get 7% in government securities. Look at the plight of all the people in most of the developed world. They get negative interest rates or zero interest rates. And if you look at it from that plight, you will find that stocks are reasonably valued when you consider that. Now, the question that you can ask is it sustainable? That negative interest rates is sustainable. For a lot of the developed world, populations have started to decline with the exception of US. So you don't need houses to be constructed, you don't need schools to be constructed, you don't need roads to be constructed if your populations are declining. So you're almost beyond that investment peak in countries like Japan and Germany. So I sometimes wonder whether interest rates are going to ever go up in some of these countries because you don't have a good demographics, and because of that demographics you have actually no need for investment. So if you believe that negative interest rates and zero interest rates are going to continue in the world, Indian stocks are reasonably valued. On the other hand, if you imply that US 10-year will go to 3%, then Indian stocks are overvalued, because I don't think Indian stocks are priced for a US 10-year interest rate at 3%. Today it's 1.7. So if 1.7 were to go to 3, I think you should see noticeable declines in most of the stock markets, including India. So the debate on valuations is incomplete without the debate on interest rate.
You know, I know, and correct me if I'm wrong, Prashant, but I think you've been betting on the economic growth coming back at some point of time in the near future as well. If that were to happen in India, and at the same time the scenario that Naren is painting out also charts out, what do you think the market, how do you think the markets take it?
So I think with every passing year, the growth outlook in India is improving. And I mean, you can read what the chairman of JP Morgan is saying, that India is probably the best placed economy in the world. So I don't think there, in my opinion, there is any doubt that every passing year the GDP growth outlook will improve. And I think the profit growth will also start surprising on the upside, because currently the margins in the economy are nearly at 2-decade lows. And when you are operating at very low margins, profit growth can actually be very quick if margins improve slightly, and I think we are at that point of time. What Naren is saying is correct, it's a possibility, but let's not forget that in equities over long periods, it is growth which leads to bulk of the returns, and it is not the small changes in PE multiples. So this index is up 250 times over 36 years, PEs have gone up and come down, but the economy is growing, and if you compound it 15%, I think yes, if something happens in US, interest rates go up more than what the markets are discounting, it can lead to a small correction, it can lead to a short-term correction. It has happened in 2013, but look at what opportunity 2013 presented, and who told you in 2013 that that index is going to nearly double in the next 2 years or 3 years?
Yeah.
Right? Yeah. But why did this opportunity present? Because outlook was uncertain and markets became very cheap, and Indian growth is here to stay. So I think yes, these global adverse developments, whenever they happen, it can lead to short-term corrections. But I don't think anyone has been able to time these in advance. It is only with hindsight that we become smarter. And I feel that whenever these corrections happen, we should take full advantage of these.
Navneet, come in on this. So in that way, how are you approaching investing right now? If there are corrections, is it time to celebrate corrections? If indeed due to global factors or otherwise there are corrections that come in, go out and celebrate them, because you get to buy those very companies at better prices.
So we were, just few minutes back, we were talking about a very small percentage of population has got money in equity, so we have a long way to go. I think at every correction, and I think Naren pointed out very rightly that I think we are seeing a new trend where the days markets are lower, you see higher number of applications that day in terms of subscriptions. So I'm sure a huge amount of money is going to come from the domestic investors, and also I think from a global investors perspective, I think that in a world which is so growth starved, which is so yield hungry, at a place like ours where you have better predictability or more sustainability of that growth and higher returns will continue to attract more money. So possibility that something happens somewhere in the world or maybe some negative news leading to a very sharp correction is relatively less from that perspective, because the sheer amount of money that is likely to come into the market, that will keep looking for those opportunities where at every correction the people come.
If it's all a rosy scenario, are there red flags in terms of flows, in terms of global events or anything which could disrupt? I mean, they're talking about currencies and interest rates, so on and so forth.
So I think two red flags that are clearly visible. One is the quality of the current account. We have been in a sense lucky that the current account is behaving, but I really don't see any qualitative improvement in our current account in the last 3-4 years. It's more of a quantitative improvement which has helped us. Second is that I believe while central government balance sheet has improved significantly, and I would say that if India is 5 balance sheets, government, bank, corporate, individual and external, I would rate the central government balance sheet to have been the most improved balance sheet in the last 4 years. Followed by household, which was always good, current account, which is good for various reasons, which are not necessarily a credit to us, but more to circumstances. And corporate and bank balance sheets are following, they are mending, but they are not yet there. But within the government, I still believe there are a lot of challenges as far as state governments are concerned.
Sure.
So I would watch very closely at state government balance sheets, which could be a drag as far as the overall fiscal is concerned. And I would watch very closely at the current account, because I believe that most of the improvement that we have seen has been quantitative rather than qualitative.
So Navneet, let's assume that all the bad events don't happen, all the good events do happen, and we are in a safe spot for the next 1, 2, 3, 5 years, as the case may be. How do you position yourself in this market?
I think it's better to focus on individual stocks rather than taking some of those top-down macro calls. I'm sure that in terms of the shift from the monetary policy, which has created a QE glut, which has fed into all the assets together, duration, credit, equities, commodities, all doing well together in this period with a high correlation, is definitely coming to an end. And maybe the fiscal will take over, doesn't matter. I don't know whether Trump or Hillary will come, but one thing I'm 100% sure of is that I think any one of them, whosoever comes, but will surely move towards a far greater fiscal spending and structural reforms to revive the economy, which will be followed by the Europe and most of the other markets. So a big spending on infra globally is coming in next 5 years, that's for sure. Maybe some of the Indian companies would be beneficiary. Some of the export related sectors are going through some challenges, but those are the larger disruptions. You have seen that maybe some signs in IT, maybe you've seen a little bit in maybe the generics. I think some of the other sectors will not remain insulated. There is a lot that's happening in terms of the technological changes globally, which will impact almost every single sector. May not be those who are like more dependent on the domestic side, but as the ease of doing business, even every business will get impacted because a lot more competition will come. If it's easier to do here, a lot more competition is going to come. But even some of those global businesses, I don't think one can completely write off. I strongly believe that maybe, of course, the BFSI sector will spend less money on IT going forward given the challenges in those companies. But if you look at the IoT, the Internet of Things, the digitalization of the global economy, the way people are moving to cloud, the mobility and all those analytics, a much larger trend. Logically, the IT sector should be much bigger than what we have today, but it's just that we have to go through a painful process where the legacy business goes through a trouble, but the new business is built, and those who make the right investment will again become 10 times bigger than where they are today. And same thing with the opportunity in the healthcare, same thing with the light industrials. Maybe India may have something in specialty chemicals. So I think both global as well as domestic opportunities are going to be there.
Prashant, you bias towards domestics, or are you now starting to look at the globally exposed spaces too?
I don't think that's a very fair way to just segment the market. And I strongly feel that we are moving towards a period of low inflation. Interest rates have fallen. No one believed that interest rates will fall, but they have fallen. I think they could fall more. I think capex will revive over time. Infra capex is reviving. It is currently led mainly by the government. I think over time we will see even private sector, industrial capex will come in. I think the opportunity in this market lies where where the earnings are stressed, and that is basically in the not in the consumer IT or pharma space. I think these are spaces where earning expectations are high to my mind, and other than these sectors, I think there is greater value for the patient investor.
So Anup, let's see if you are guys on the same side. I mean, are you looking at buying compounders? Are you looking at buying stressed earnings? Are you looking at doing a mix of both? I mean, the mix of both is the easy answer.
So let me confuse once again by giving you an answer which is
Awesome.
totally different from.
Yeah, love
so
that.
if you look at the last 4 years, one trend which has emerged is that companies that are leaders have grown at a pace far faster than the number 3, 4, 5. And the industries are becoming a bit like the case of newspaper or TV channels. The top two companies get almost 90% of the profit of that segment, and the rest just play in it to give them competition. But they just, and in terms of market cap, it's even more concentrated. So I think that's one thing where that I think that it's now been played to the hilt, that the top two companies in every segment today are trading at a PE levels which are 40-50% higher than the number 4-5 player, and it may or may not be justified from case to case basis. But if we are building this hypothesis that we will continue to grow and grow faster than what we are growing at current pace, then then these players will also go and participate in growth, and there you will get a big bump up in terms of valuation, that their PEs could get re-rated, whereas those who are the leaders already are trading at a very high PE or very high multiple. So I would see it from that point of view rather than sectors or segments of the market.
Okay, interesting. I think we're coming to the end, so let me just try and squeeze in closing comments from all, at least Amit and Naren as well. So Naren, how are you positioning yourself right now? I mean, in the past, I think the last couple of years, you also had a bit of contra themes as well working out. What are you doing right now?
Yeah, I think clearly we are a believer in a moderate return story with the operating leverage playing out domestically over the next few years. Some of the global sectors, like last year metals had corrected, this year it is tech which has corrected. So there's a lot of case for doing research on the tech sector. From a contrarian point of view, I bet on telecoms, saying that every day you see news.
I want to ask you that.
So that is a contrarian sector. And clearly if you look at, I think where I and Prashant are on the same page is quality sectors, quality stocks across market capitalizations are trading at very high valuations. So you have a lot of quality mid caps trading at 50 times trailing, and in the past you have never made money by investing at that kind of multiples, but I would agree in the last 2 years we've been saying this, but it hasn't yet played out. But I think eventually it will play out by the other sectors doing well. I don't think these quality stocks we can really bet against because they're all quality stocks. But I think clearly the rest of the pack have to do well when operating leverage plays out. And I hope US doesn't do more than 1 or 2 rate hikes. That is my only hope. That's my only worry. Frankly, if you ask me at this point of time for the next few years, we've had a good monsoon, crude doesn't look like shooting up. The only worry we shouldn't have is US interest rates.
So UP 2017 or India 2019 is not a worry?
I think that is not a worry, I would say. Clearly, I would say 2019 would be a worry, and which is why I use this 2-year term. But 2017 is not a worry.
Not a worry at all. Okay, fair call. Amit, for you managing your portfolio, I mean, there's a lot of, unless I'm wrong, there's a bit of a dichotomy amongst thought of where the interest rates are headed as well over the medium term. What would your scenario be?
So I think we are directionally downwards, clearly. On the point on US rates, if I could add my 2 bit,
Sure.
is the fact that it's an event, and hence it's an event risk. At the same time, what you should realize is just 2 things. One is trend growth rates are much lower globally, including the US, which basically means terminal Fed funds rate will be much lower than what we have seen in previous cycles. That's something that the market is clearly convinced upon, and that is what you see irrespective of whatever policymakers say. The market tends to behave in a manner which suggests that trend growth rates will not be the way we have seen in the past, especially in developed markets. In the context of India, between 2000 and now, when you really have seen market rates at play in Indian debt markets, the gap between an Indian 10-year and the US 10-year has been as low as 250 basis points in the past and as high as 700 basis points in the recent past in 2013. I agree on the point on inflation that, a 5-6% inflation is not a very low number when you're talking about 0% globally. But as long as the core inflation trajectory stays below 5%, you can easily see this differential that today is roughly 550 odd basis points coming down and sustainably staying down in a range of 300 to 400 basis points. So I guess one should never talk about numbers. When we were at 8.5, 9, nobody talked about 7. When we are at 7, why should we talk about a finite number of 6.5, 675, which is what everyone keeps about talking about what will happen in the next quarter.
Sure.
I would tend to believe that as long as directionally it's going lower, and much more importantly, as long as liquidity conditions are good,
Sure.
you could see a meaningful move from here as well. And the second place where we would concentrate from a debt market perspective is lending to corporate balance sheets where we are seeing meaningful improvements. In good liquidity conditions and meaningful corporate improvement in their balance sheets, you can actually make very reasonable returns without taking too much of interest rate risk by running neutral duration portfolios as well.
Yeah, let's join our hands for these wonderful minds as they've spoken about. Thank you so much.
Find us on Facebook at facebook.com/etnow and don't forget to click the like button. You can also follow us on Twitter at @etnowlive. To stay updated with all our programming, hit the subscribe button on our YouTube channel by logging on to youtube.com/user/etnow.